Today, wages grows 3.3% for the year, but inflation is at 7.8%. We speak with the CEO of Flight Centre, Graham Turner, and consumer behaviour is changing, why more are opting for pizza pickup instead of delivery. Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 22nd of February 2023. First to wages, where the wage price index rose 0.8% for the December quarter to be up 3.3% for the year. That's the highest in about a decade, but well below the rate of inflation at 7.8%. For more, I spoke earlier with Paul Bloxham. He is the chief economist at HSBC.
A downside surprise for the market, for the RBA, for ourselves actually. It's the case that the labour market's very tight, but wages growth is still picking up pretty gradually in the scheme of things. A 3.3% headline rate for wages growth is something that the RBA actually should still be pretty comfortable with. Wages growth of 3 to 4% is what they've been looking for. So this is actually quite a good result. But as you say, it was a downside surprise. So it should take the pressure off the RBA to feel the need to have to deliver a lot more tightening from here.
We'll go into that in a few more details. The RBA says that it's pretty worried about the potential of a wage price spiral. Are we seeing any evidence of that at all?
Now, these figures help to sort of allay the risk, as it were, that we could get a prices wages spiral, as the RBA has been describing it. That would be one where the high inflation starts to lead workers to demand higher wages, and then they get those higher wages, and then that starts to impact on prices as well. These numbers certainly should allay the fears that is already getting going. It doesn't seem to be getting going yet.
Okay, but we hear so much anecdotal evidence of some organisations paying huge pay rises, paying huge sign-on bonuses to attract talent. What are you seeing? Is that reflected here, or do we have to wait for other data to confirm that?
These numbers contain a measure that includes bonuses as well, and that measure actually slowed down a bit as well into the fourth quarter of last year. And so you're right, there's a lot of anecdotal evidence out there. In fact, the RBA's own business liaison program that they reported to us a couple of weeks ago was telling us that wages growth was picking up and that was an element of it. But these figures, these are the broad-based survey numbers. They're showing that there is a bit less momentum than was expected.
What does this mean then for the rising cost of living? Because consumers aren't necessarily seeing their wages keep up with inflation.
This is certainly a challenge. Households face an environment where inflation is running well ahead of wages growth. So that's squeezing their real wages, the ability for them to spend. At the same time, of course, as interest rates are rising too, house prices are coming down. This is a pretty challenging environment for the household sector as a whole. But you've got to keep in mind that will also likely slow in the economy down and then slow down inflation too. This is the way the mechanism works in terms of getting inflation to come back to where it needs to be.
And in the more immediate term, if real wages are going backwards, isn't it enough to convince the RBA to halt its rate rise moves?
This is certainly something the RBA should take a lot of notice of. The fact that wages growth is not picking up as quickly as they expected. There are limited signs of a price wages spiral at this point in time. We think the RBA will still be quite focused on inflation and that we should expect that they probably will lift rates again. But I think this information tells us that a pause for the RBA hiking cycle should come fairly soon.
That is Paul Bloxham there from HSBC. We are heading through a profit reporting season. One of the companies posting today was Flight Centre. It saw a loss for the half year of $18 million. That is an improvement, though, as travellers return despite higher airfares, although there are signs those airfares may start coming down soon. For more, Rhayna Bosch spoke with Flight Centre CEO Graham Turner.
Flight Centre Travel Group is on the way back to probably pre-COVID, but we've still got a fair way to go. In different countries, the airline capacity, the seats available, particularly on international routes and particularly out of Australia, are still a fair way behind, pre-COVID levels, which means airfares are more expensive. harder to get seats on certain routes, even at relatively high prices. So there's still plenty of challenges, but we've seen since the borders have reopened, we've seen a consistent month-to-month improvement in our results. And, we're between our corporate and leisure business, we're back to probably close to, about 85 to 90% of pre-COVID TTV. But we've still got a fair way to go, as I said before.
And what are you seeing in terms of flight availability and capacity limits? Have they returned to pre-pandemic levels yet?
No, it's not. Particularly out of Australia, New Zealand, we're still at about, I believe, at about 70%, excluding the Chinese carriers. Now they're coming back in as we speak. So we expect overall capacity back by June by something to about, this is international, about 85, 90%. So, and certainly by Christmas, those numbers still down a little on pre-COVID. And every geography, every country, it varies a little bit. Domestically in Australia, depending on who you ask, it looks like we're back to about 95%. But airfares are still, as you know, generally 25 to 35% higher than pre-COVID.
Well, we know some airlines are holding back in terms of boosting their capacity limits. Are they justified in doing that? And who are the worst offenders?
Look, some are, but it is a competitive industry. And for example, whether it's Asian carriers, as they come back, they won't be holding back capacity. The Middle Eastern carriers are a bit of a mixed bag. Emirates has come back quite strongly. Qatar, which is one of the Middle Eastern airlines, wants more capacity into Australia, and all they need are the rights to fly here, and they'll bring back more capacity. Whereas some of the other airlines, particularly the home carriers, whether that's Air New Zealand or Qantas, they're I did read that Alan Joyce said that they've brought back more capacity than some of the overseas carriers, but they probably don't want too much competition too quickly, and because obviously they've got a lot of missed opportunities to recover over this period, and a post-COVID period probably for the average airline only happens once in a lifetime. So they will be taking advantage of that, and it's probably fair enough.
Well, Graham, we've seen the impact of inflation. Costs are rising. People are struggling. Are households perhaps putting off travel as a byproduct of that?
That's a good question. We're not seeing it generally yet. There's a lot of demand. As a matter of fact, we're struggling to cope with the demand because we're still relatively short-staffed in some areas. But bear in mind, particularly international travel, it's not particularly discretionary. People who want to travel internationally generally are mid to higher income people. So probably the inflation hasn't hurt them as much as the lower income sector. So we're not seeing that yet, but depends on how long this inflation continues and what the impact, when it starts impacting the middle income earners. We'll just have to see. We're reasonably confident that generally people will continue to travel either domestically, but to see relatives or to holiday, but particularly internationally, holiday and business. I don't think it doesn't appear that this high inflation and the particularly lower income people, the way they may be hurting, is impacting things at the moment anyway.
Finally, Graham, if we can just turn our attention to cruise lines, they have been massively impacted by COVID, and many people were seen to boycott them in the early days of the pandemic. How are you seeing their recovery go? Yeah,
well, you ask about cruising, and one of the things to remember about cruising, it tends to be an older demographic, and they tend to book a long way ahead. In Flight Centre, which our leisure business is about $11 billion, cruising has become an increasing part of that over the last 3 or 4 months, as people look well out into the future. As I said, late, a lot of bookings for 24 and 25 now. And I think people assume that everything will be back to normal from a COVID point of view but when they go cruising. So it might have affected things in the last 6 or 8 months, 12 months ago, but now the confidence seems to be back in cruising from what we're seeing anyway.
That was Rhayna Bosch speaking with the CEO of Flight Centre, Graham Turner. Now to the Australian share market, which did fall today by 0.3% on the ASX 200, 7,314. For more, I spoke earlier with Mark Gardner from Maqro Capital.
Obviously, this time of year, we're very focused on individual company earnings. But outside that, we obviously had a weak offshore lead from the US, which was largely driven by 1 and 2 year bond yields breaching those November highs from last year, which is the highest level they've been since 2007. It's obviously making investors fairly nervous as it's sort of starting to raise the peak or the terminal rate in interest rates. We also had wage inflation numbers today, and the RBNZ went by 50 as expected. So that wage inflation number was slightly lower, which probably gave a small pause to the selling pressure that was sort of going on earlier in the morning.
In terms of that wages data, it's another piece of the puzzle for where interest rates will go here in Australia. What's the market now thinking?
I think it was very unexpected being slightly lower. It was still up 0.8, but we've got an unemployment rate here at 3.7% at the moment. Ideally the RBA will probably want the employment rate back, firmly in the 4s, and otherwise we are going to have wage inflation down the line. And wage inflation generally is a laggard to consumer inflation, and I would expect the pressure on household budgets at the moment to really put pressure on people to go and approach their boss for more wages.
Speaking of household budgets and pressure, we had lots of profits out today. The two I want to focus on for now are two food-related businesses. One, Woolworths, which the market liked. Then there's Domino's, which investors punished. Why?
This really was a clear sign that household budgets are being constrained. We had Domino's. A lot of customers basically have chosen to pick up, which is a much lower margin part of their business, and they also had inflation for mozzarella and rising costs for all of their inputs basically. They had repeat store sales down, and obviously that plays into Woolworths because we had a 2.4% increase in food sales, even though there was food inflation, because people are obviously choosing to eat at home and save that money because mortgage pressure, rising fuel costs and other inflationary pressures are putting really tight constraints on the household budgets.
Which other profits caught your attention today?
Santos was one worth noting. Santos is Australia's largest gas, or one of Australia's largest gas producers and exporters, large operations in Asia Pacific region. They had a bumper report. Profits were up about 200% plus. They were able to increase their dividend by 80%. Shares are only up about 3% on the back of that. This is just due to the natural gas prices, which have fallen 51%. Since the start of 2023 on that mild European winter. So obviously going forward, that's a huge decrease in the underlying commodity that Santos is selling. So the outlook was very important there in terms of how they're going to go going forward.
We're well and truly halfway through profit reporting season. What do you see as the key themes?
It was always going to be hard to live up to investors' expectations. We had a 6.5-7% rally there in January. And we had a lot of big companies like CBA, for instance, trading at really stretched profit or earnings ratios. So, they really had to deliver extraordinary results and a great outlook to maintain those prices. CBA's result and a number of the retailers like Nick Scali, JB Hi-Fi, etc., all released, in line with expectations or slightly better than expected results. However, the outlook, obviously, for the retail sector on those constrained budgets and CBA probably not going to be writing the same amount of new loans going forward is really going to dim their outlook overall. So, obviously, we had sort of sell-offs in a lot of those stocks just on the back of forward expectations.
We're well and truly halfway through profit reporting season. What do you see as the key themes?
The sectors we're leaning towards are mainly energy, healthcare, and obviously now with interest rates, corporate bond rates around 7% mark, AAA bonds are around the 4 to 5% mark. For the first time in about 15 years, you've actually got the opportunity to go into risk-free assets, which actually yield, a decent amount. So obviously outside that, we're looking at companies with really strong management. 20% of the ASX 200 has never operated outside of a zero interest rate environment. So experience in management is going to be really key there for them to be able to, maintain and navigate this period with higher interest rates. Similarly, about 20% are not profitable either. So it's not a situation where company can come hand in hand anymore and ask for cap raises at zero interest rates. So management is going to be very key, and obviously companies, tech companies or the like with a competitive advantage or a moat, as we call it, will do quite well because they'll obviously be fairly immune to inflation pressures.
Mark Gardner there from Maqro Capital. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial